Thank you, everybody, for being with us here. My name is Jamie. I'm a head of financial planning and editorial at Endowus, and it's very nice to meet all of you here today. We will start shortly. We have not started yet, and that is because I think we still have the live stream to go on yet. So I think that hasn't started yet, but good, you're all in your seats now. That's wonderful. We have about 1,200 participants that have signed up this afternoon. We just want to make sure everything is in order before we start. So if you just hang on tight and we'll get started shortly. Right now, in fact. Ladies and gentlemen, welcome once again to the Endowus 2023 Market Outlook event. I'll be your MC this afternoon. My name is Jamie. Once again, I'm head of financial planning and content and editorial at Endowus. We'd like to welcome more than 1,200 participants who have signed up this afternoon for this event. And to those who are joining us on the public live stream, a warm welcome to all of you as well. The title of our Outlook event this year is Navigating Through Turbulence, as we have there. Now, following a turbulent market in 2022, how should investors be positioned in 2023? We've gathered experts from leading fund management firms that manage over $1 trillion in global assets to share their valuable market insights. Expect to be challenged, refreshed, and go back with a lot of investment ideas from these best-in-class asset managers that partner Endowus very closely. To kick us off, may I invite our chairman and CIO, Samuel Rhee, to say a few words. Sam, please.
Thank you, everybody. It's great to be here. Thanks for joining us at this 2023 Outlook event. It's an annual event that we have hosted a few times. Last year, COVID put a stop to the in-person event, but we're back together again, so really excited about this. I'm going to maybe quickly run through the slides. Some disclaimers, first of all. We are a MAS licensed entity, financial institution. Also, I wanted to give a very brief introduction about Endowus for those of you that may not be as familiar. Endowus has had quite a journey over the past 3 years that we've been in commercial business. But as the market last year showed us that a lot of the wealth, we've seen a lot of destruction because people trade or meme stocks or crypto. Endowus is not that company. We're a fintech, but we're not about trading faster. We're not about speculating more. We're trying to really build a platform and a business where individuals really have an institutional framework of investing their wealth for the long term, especially for long-term financial goals such as retirement adequacy. Endowus is what we think is the end game. When you're done in your 20s and 30s trading crypto and meme stocks, you're married in your 30s and 40s, and you're building a family and a career, you should be on the Endowus platform, investing for the long term in the right way. So our growth journey, we were the first and only digital advisor for CPF. So effectively the only digital wealth platform that's approved by the government. But we've been growing well since 2019. Over the past 3 years, we crossed 2 billion of assets last year. And we made our first acquisition in Hong Kong, a private company called Carre Private, which caters to the needs of high net worth clients. So we crossed 4 billion of assets. We also, most importantly, the chart in the middle, returned over $5 million of trailer fees. Now, Endowus is a company that believes in the future of wealth being independent, conflict-free, and fee-only. So we are not paid by anybody else other than you, the clients. A lot of the banks and brokers and traditional financial companies actually get paid commissions for selling financial products. So we do not keep a single cent of the trailer fees and retrocession that we receive. We give that 100% back in the form of cash back. So we've crossed 5 million. But we also have a lot of institutional funds and funds that are not accessible by other platforms. So the amount of savings that we've given investors, we believe, could be in the tune of about $20 million. So it's a phenomenal achievement for a young company in such a short space of time. It's important that we work together with fund management partners. So we started with public market, equities, fixed income, traditional assets, passive, and then active, and then systematic solutions. but we've now evolved and are also providing private markets and alternative solutions with many of our important partners. The fund management partners do what they do well, which is build and manufacture wonderful products and solutions. And Endowus does what we do well, which is curate that into the right selection of funds and products and negotiate the lowest cost, and then build advice and portfolios on top so that individuals can meet their personal goals with the right solutions that's appropriate for them. So it's a hyper-personalization process. We also are very, very missional about content. And this is why we host these kind of events here. We have a lot of content on our insights page. If you think about how there's only 4 million adults in Singapore, 1 million unique views over the past 12 months is a phenomenal achievement and show the breadth of reach that Endowus has. But also, our webinar since COVID began, and this is being streamed live as well, which is publicly available and free. All of our content is free. We really want to help individuals be empowered, be educated, so that we can improve financial literacy, so that we can achieve better outcomes. Just a quick look back on the macro and the markets. Last year was obviously a horrible year for all of us. It was a painful year. It was a very unprecedented year as well. You see how far off left that red dot for 2022 is, where equities and fixed income had high correlation and was negative in a significant degree. And also, but at the end of the year, obviously, JP, next slide, we saw a bit of a rebound and a little bit of risk appetite coming back. So we have a lot of panels on macro, equities, fixed income, alternatives, each asset class, where we will discuss, what are the implications of some of that risk appetite coming back? Can it last? Next page. Also, what was interesting though, in that rebound in the fourth quarter, value continued to outperform. So growth has been underperforming for quite a while. And despite that risk appetite coming back, value actually outperformed. So that's an interesting thing that we can maybe delve into in the equities discussion. Next page. Geographically, obviously, we've seen a massive rebound in China. So a lot of the markets rebounded from October, November. There's a wide dispersion of returns across different geographies, and China, after underperforming for a long time, has come back very strongly. So the question is that sustainable? What's the implication for emerging markets? And EM versus DM, where the US will continue to underperform. Next page. A lot of people have been talking about inflation for a very, very long time. This is a chart that we've shared in our previous Outlook events about, if we forecast the month-on-month inflation rate to be 0.1, 0.2, 0.3, and how that will look on a year-on-year basis, because inflation is not a static number or an absolute number, it's an index, and therefore it's a year-on-year number. So you can clearly see the trajectory of inflation coming down depending on whether inflation decelerates at a very fast pace. The last two prints were closer to 0.2 trend, but it could go back up to 0.3. So inflation definitely is coming down, but the pace of that is really important to the future direction of interest rates. And then the Fed obviously has been hiking aggressively, but we always say the market reflects all known information at any given point in time. This is true for macro indicators, but also equities and fixed income to a lesser degree. But you could see that the market was way ahead of the Fed, pricing in expectations of Fed rate hikes throughout last year. And the Fed hike is 4.5%. We'll see how much they increase. But obviously the attention, I think, now is shifting a little bit. So this survey from Amundi actually showed that the biggest risk that investors thought faces us is actually the Fed tightening, over tightening. And we're starting to see, we saw the retail numbers overnight slow down quite dramatically. And I think the next page will show that, a lot of concerns about growth. So I think that concerns about inflation is shifting to growth, and we'll debate that in the first panel, in the macro panel. And finally, I think some implications of that, the dollar strength has finally kind of peaked. So the DXY index has peaked and is starting to come down. It was a massive outperformance, and it's come off quite sharply. People don't realize. So it's interesting to know and how this will pan out, so we can discuss that. And then finally, the big question that a lot of people ask me is, is the 60-40 portfolio dead? It had the worst year in like 40, many decades. So most of us were not investing even or alive, some of us, when this happened last. But massive underperformance. And we highlighted this 3 months ago in our previous quarterly presentation that, the 60/40 has had a massive underperformance. Since then, from October, it's actually bounced back quite well. So the question is that sustainable? So with that, I'm gonna hand back to, I think, Jamie. So please enjoy the sessions and please participate with any questions because we have Slido. We'd love to have more audience participation here in person and virtually as well. Thank you.
Thank you very much, Sam. Without further ado, let's welcome on stage our valued partners who will kick off the Market Outlook event. Once again, all panels will come with Slido questions, so please send your questions over. We will begin with a panel that will take stock of the macro environment, so let's run straight into introducing our speakers. First, let me welcome our speaker from UOB Asset Management with more than 30 years of experience as head of multi-asset strategy unit. He leads the team in monitoring global markets, forming the in-house view of likely market outlooks and performance, making investment recommendations, and developing and managing a range of asset allocation products. Let's welcome Tony Raza from UOB AM. Next up, from Lion Global Investors, yet another experienced hand with 25 years of financial experience. As head of curated portfolios at LGI, he is responsible for building portfolio solutions for clients and partners. Please welcome SK Selvin from LGI, excuse me. Joining the duo is a former macroeconomist with GIC for a decade. Today, he is the strategist at Fullerton Fund Management and works closely with the CIO to formulate and drive the fund house's global investment strategy across asset classes. Ladies and gentlemen, from Fullerton, Robert Wayne Sinclair. Last but not least, she leads the Franklin Templeton in-house macroeconomic thematic investment research to deliver capital market and long-term investment insights across various asset classes in Asia Pacific. Please welcome Christy Tan from Templeton. Rounding up our panel is our moderator. Prior to his role as chairman and CIO of Endowus, he was CIO and CEO of Morgan Stanley Investment Management in Asia. He comes with more than 27 years of institutional investing experience in Singapore, Hong Kong, and London, and is a familiar face to many of our clients here. Ladies and gentlemen, from Endowus, Samuel Rhee.
Decided to skip the pin mics and go with the hand mics, so everyone has one each. Thank you, guys. We're gonna jump right in. My experience is now 28 years, by the way. We need to update that bio. Getting older by the day. Great to have this illustrious panel with me. Amazing that we can gather such amazing years of experience and expertise here and wisdom. So thank you guys for joining us. I'm going to start with a very quick warm-up, quick-fire format question. And we discussed this before we came up, so it's a bit more interesting than the usual yes-no answer. Do you think equity markets will be higher or lower by the end of the year? Christy, ladies first.
Thank you. Thank you for having me. Good afternoon, everyone. Well, the short and quick answer to that will be a yes, a resounding one. And I'll qualify.
Resounding. Same with that.
Yeah. Well, let's start the year of the rabbit optimistically. But I'll qualify that to, the US stocks. And, the first chart that Sam showed earlier on, which showed that 2022 was an unforgettable year because both stocks and bonds actually declined by the extent of almost about 20%. Now, but what is important in that slide is also that there has only been 5 instances since 1948 that has happened. So if we look at then, the majority of the performances since 1948 has been basically 40% of the time stocks and bonds have diverged, and 60% of the time stocks and bonds moved in parallel direction, which is upward. So, and that's also been shown that in the average upturn years, rather immediately after a downturn year, the average gains for US equities is 16%. So I think that's basically why, I think the answer is yes.
Okay, quick fire, guys. Okay, Robert, thank you.
Yes, good afternoon, everyone. And it's Fullerton's great pleasure to be involved in this conference. So thanks for having us. Our short answer is we are positive on global equities. We do see upside this year. Largely that reflects a fundamentals-based approach where we've looked at what the market seems to be pricing in, which is quite pessimistic, especially with respect to the likely paths for earnings growth and for GDP growth. So we do see some upside potential as those numbers come through and are realised. We have a quick picture that shows the argument, I guess. If you just focus on the global picture, the orange line, that's global earnings growth expectations. That's slowed down quite a bit. It looks like it could be troughing. There could be a little bit more downside, but I guess the thing that really stands out in the picture is the purple line, which is market pricing, which is quite pessimistic and actually translates to around 0% global growth, which we think is just a bit too bearish given the consensus view for 2%. So we think the market will revise itself up and we will see a rally in global markets.
Fantastic. Thanks, Robert. Selvin, moving on to you. Let's do something different than up.
No, so our house view is that we are neutral on global equities. We don't think there's going to be a big downward correction this year. It might happen, sometime in the second quarter as earnings get slashed. I think net, I think we are going with a plus minus 5% for equities. Not much of an upside, not much of a big downside. I think valuations are fair, not cheap, but there is a risk of an earnings recession, maybe together with the economic recession. I think that's where the biggest risk is. Analysts are still very complacent, sitting on their hands, not cutting earnings yet, still waiting for data points to come out, still waiting for earnings guidance to come out.
That may be upon us. Tony.
So yeah, I think returns will be positive this year. Also, I would say that I think compared to 2022, where, as a multi-asset investor, it really stood out that one of the problems was everywhere you turn, things were performing badly. Stocks, bonds, commodities really didn't have a good year. They had maybe a good first quarter and then suffered the rest of the year. Gold, crypto, everything was struggling. And what I would highlight is I think this year I actually think everything makes money this year. And I think, we can discuss it more in this panel, but my quick takeaway would be that some of the asset classes like fixed income, I think are very hard not to have a positive year like this in this year. And equities are more complicated depending on the level of the slowdown. But really, I think by the end of the year, markets are going to be looking past the slowdown. And therefore, I think across the board, as bad as 2022 was, I think 2023 is heading up better.
Fantastic. We'll leave some space for the equities and fixed income panel to discuss those specific asset classes. So we're going to move on to macro, since it is a macro panel. Inflation, front and center in everyone's mind. Are we getting now a bit too complacent? Like, even my slide, people will say, oh, the guy's optimistic about inflation. Or is it the other way around, that we're actually still too concerned about inflation and we should be more worried about growth? Maybe, again, let's start with Christy, and I'll have Selvin answer. If you guys want to add, we'll have two people answer each question from here on.
Yeah, thanks for the question. I think it's an ongoing debate. However, there are increasingly signs that some of the sources of inflation, which were initially supply chain driven due to the pandemic, due to the Russia-Ukraine war, there are signs that those pressures are easing. And then also we know that the Fed is there to fight inflation at all costs. So that will be a policy-driven kind of initiatives that will also push inflation lower going ahead, although it will still be quite elevated. And I think, the 2% target is at this point still looking very, very, I would say, aggressive and probably over-optimistic. And the other thing as well is that if you look at signs in the US, housing prices, and also the amount of excess savings that has actually been drawn down quite significantly. So the other sticky point is shelter inflation, and that is something that will probably still be quite sticky, on an upward basis for the time being. But the other pressures coming to push inflation higher initially has actually diminished. And I think that suggests to us that the trend going forward is downward.
So shelter meaning housing and rent.
Housing and rent.
Yeah. Selvin.
I will just comment on core inflation because I think that's more relevant. On core inflation, we take the view that core inflation is going to remain sticky. By end of this year, we are thinking that it's going to be at 3.5%, still very far from the 2% Fed inflation target. Now, something that I want to give the audience a takeaway is that a big part of the core inflation is actually services. So if you look at last week's data print of 5.7%, a big part of that is actually services, and services inflation is still climbing upwards. And if you delve deeper into what this services inflation is all about, it's actually all wages, right? So if you think about the US, there are 10 million jobs up for grabs. There are 5 million job seekers. So for every one job seeker out there, there are 2 jobs available. Wage inflation is still running at 5 to 6%. I can't see this problem solving unless we have a recession, right? So until we have a kind of a deep recession, and I think we're starting to see layoffs already. We see the Goldman Sachs and the Microsoft laying off, but this is not the real job situation. I mean, US is really very big. So I think that the core inflation is going to remain sticky. The Fed's going to remain adamant. And if we get a mild inflation, the Fed is really going to stay put. There's no Fed pivot coming on.
Okay, fantastic. A different view, which is great. Now, I mean, since we're on the subject of inflation, the Fed, those of us who are old enough in the 90s, the mantra was don't fight the Fed, it's back. We talked about the Fed put. So I'm going to go the reverse this time and ask Tony and maybe Robert to comment on your views on the Fed interest rate trajectory. What are you expecting in light of the inflation comments?
Yeah, so I think sometimes you can fight the Fed. I think this might be one of those years.
Let's do it.
If I could be so bold. So the way I would describe it is, again, it's going to be tied to the inflation story. And actually, I think both Christie's and Selvin's points were right. But I think where we come down is I'm actually impressed with how well inflation's improving. And I think like Selvin was right to highlight that the scary part of it is that core services number. And built into the core services also is the rent component. So I think you two are highlighting exactly the key issues. But I would say, so I was back in the US over the holidays. I think it's really clear. Everybody knows the property market has cracked. Rents are actually right now negative. But it's in the CPI numbers, the way they calculate it, it's really laggy. And so I think it's going to get complicated for the Fed because do they really keep raising interest rates to cool down their numbers that they know are at least a year behind the real market conditions? And therefore, are they trying to get down the CPI, numerical number, even though they know in the real market rents are already negative? And so I think more and more what they're going to be doing is looking at core services, excluding rents, and they're going to see those numbers, I think, are looking better. As a matter of fact, the way we've been calculating it, we take the CPI number, we take out the rents, which have been really high, and we're already getting negative numbers, everything else. And that's because there's some other component. The medical services were really high, and they turned negative. It's another pandemic effect and so forth. But anyway, I guess I don't mean to make it too complicated, but I just mean to say, when we break it down, we find reasons to be optimistic. And I think then what you're going to get by, I think, the middle of this year is the fact that the CPI numbers are going to look more comfortable if you're looking at it, for example, ex rents. I also think the headline number is going to be really comfortable. I think one thing that stands out is like the headline number is still like 7% year-on-year growth rates, but it comes from the fact that it was 10% in the first half and 2% in the second half. So if that second half continues, by the middle of this year, I think the Fed's gonna feel a lot less pressure to keep fighting things. And then on top of that, I think there's already signs that the economy is slowing. And then the Fed's gonna be put in the position, do they really want to create a recession and unemployment when there's a lot of evidence that inflation is maybe already improving? So thus, right now, there's a big difference between the market think interest rates are going to be and what the Fed thinks it's going to be at the end of the year. And I would lean to thinking, I think the market's right on this. And I I guess
Unfortunately, the
remains to be
market
seen.
was right on the way up.
Yeah.
And so I think there is, and I showed that chart earlier, how the market moved earlier on, it was almost 3+ months ahead of the Fed's actual actions. And I guess the Fed is constrained by the fact that they have to speak. The Fed speak, the rhetoric has to remain strong because they're trying to manage inflationary expectations. So in light of that, Robert, maybe you can extrapolate on, what you actually think Fed will do and whether following on from Tony's comment, do you think the market will be right or the Fed will be right?
Yeah, so our view at the moment is that we kind of align with what the Fed presented in December. And so that's with a peak Fed funds rate of around 5 to 5.25. So we're kind of almost there, and there's a nice picture that kind of summarizes the Fed view, the bar charts. I guess one of the key takeaways from that is if you look at the consensus in terms of how much disinflation is expected this year, or the Fed, they're more or less the same. They're expecting 2.5 percentage points fall in inflation. And that means no rate cuts until next year. They want to make sure that that is realized. I guess where the more dovish market pricing comes back to your earlier issue about what's the bigger risk, inflation or growth. And I guess our judgment at the moment is that the market could be a little bit too bearish on the growth outlook. The other interesting, I guess, element to this, of course, is that the Fed and the consensus view is aligned on the unemployment cost. Unemployment is going to rise by about 1% this year. So we kind of are in the camp of maybe not to fight the Fed. We do think, I guess the other point too, is that inflation is quite a sticky process, as has been highlighted, and it is going to take until 2025 until they get back to target. So they have to keep focused on the objective, and I think, that's no rate cuts till next year.
Why don't I just stay with you, Robert, and just maybe follow on, because recession is now a firm reality in most people's minds. I guess the question is, is there a possibility of a soft landing where we avoid recession? Is there a hard landing risk of a deep recession, especially if the Fed does too much? Maybe some views about that, and, is stagflation a risk still, or is that gone? Those kind of questions on growth and recession.
Yeah, I mean, I guess on the stagflation issue, like your survey response, we are less concerned about that. We do see that wage pressures are peaking in our view. Some of the leading indicators for wage pressures have already rolled over in the US. Unemployment's still yet to rise. So there will be more downward pressure that will come through there. So we're a bit less concerned about the stagflation issue. I think when it comes back to the growth outlook.
It's a big question.
Sorry, lost my train of thought for a minute. So when it comes to the recession, it all comes back to degrees. So the consensus is believing zero growth for the US this year. The Fed has a small positive. I think shallow recession could be a small negative. That's what the market is wrestling with at the moment. I think the reasons to be not so bearish in terms of the growth outcomes is three key factors, I guess. One, the consensus view and the Fed view that unemployment this time around can hold below 5%, and that is conditional on the Fed easing later on. And I guess the other key thing, a lot of people focus on the labor market, but the other things that's also important is private sector balance sheets in the US are still quite strong. And I guess the other key factor, and I have a picture of that as well, is that credit growth going into this cycle is very strong. And so of course it will slow with higher interest rates, but I think that starting cushion for credit may give some insulation to the real economy. Thank you.
I stayed with you because you had the slide up, so we can continue. Yeah. Christy, growth, recession.
Yeah, so we do have the view that the Fed is unlikely to pivot anytime this year. And a large rationale for that is that likely the recession will be quite a shallow one. And I echo some of the views that Robert mentioned, that corporate balance sheet is still strong. US is still a large consumer market. We do have indicators, be it manufacturing, labor market, and that have shown that they are negatively contributing to the US economy. However, if you look at, again, past recessions since the 1960s, probably like 8 to 10 episodes of those. And a typical recession looks like, it will last about an average 10 months. So the shortest was 2 months during the pandemic because government went in, and basically handed everyone cash. But the longest one is about 16 months. So I think we are looking at a typical recession, probably starting, it's hard to time it, but, likely second half of this year, and lasting about 10 months. Yes, we are leaning towards a shallow recession, barring a lot of shocks that is not factored in. For example, another pandemic, or the Russia-Ukraine war escalating to a different level altogether. So, barring all this and some of those unaccounted for, we think that it is not a jobless recession. In fact, it is a job-full recession that is happening in the U.S.
Well, that's a good phrase. And I guess, the known knowns are all out there: Ukraine war, China, COVID, supply chain. There's so many lists that we can go on. And inflation, even Fed. So it's the unknown knowns or unknown unknowns that are always the problem, right? When we're looking ahead. I do want to maybe touch upon something. It's not on the list, guys, so I'm going off script here. So we're just talking about US a lot and growth, in the US and developed markets maybe to a slightly more extent. But can we go a bit broader? I mean, China is the hot topic, so we can't not talk about China. Can somebody maybe venture a strong opinion on China, both whether it's positive or negative? Anybody want to go first? Tony, please.
Yeah, so I think that's a good point. So I think, this year we're more willing to invest in equities. And within that, we have Asia as our top overweight. We like
Asia as opposed to EM or a single country.
Even Asia within EM, and then Asia over developed markets as well. And then I think the case obviously starts with China. The reopening is just I think by the end of the year, we'll look at it as the most important economic event that's going on. They'll have the most legs and most biggest effect across the global economy. And that's, I'm kind of almost surprised with how much negativity there's been associated with the reopening. It seems like all I read about is the number of cases and so forth and anxiety over that. But for the most part, that's very powerful for us. The second point I would highlight is just, valuations are better in Asia. I mean, that's been an ongoing story, but that primes it for when things start to turn. I would also highlight that things like higher interest rates aren't usually a problem for Asian economies. We've been dealing with it for a long time. For slower growth economies like Europe or the US, that can weigh on growth to a larger degree than it should weigh on Asia. And so I think there's a number of fronts that speak well for it. And, we've been talking about the CIA markets. China, India, and ASEAN really all seemed set up to have a good year this year.
Okay, great. Selvin, you want to elaborate? Maybe just China's actually, despite what Tony said and the macro and a lot of negativity and a lot of it in the news, market's up 50% from the lows. Tencent is up 70, 80% from the lows, I think. So, it has bounced. So what from where now, basically?
So we think that announcement came as a surprise. Everybody was expecting first quarter of this year, but it came in December. I think China has more legs to run. A lot of people were saying just about 6 to 9 months ago that China was uninvestable, right? And people kind of labeled President Xi as the next dictator, putting him alongside Putin. But he's a dictator who listens, right? So when people are upset and they're not happy, they're protesting, he actually made some concrete moves to open up the economy, let people breathe and let people move about. So I think China is a different story. So we can't put China alongside Russia. So I think there's a lot of money going to come back to China. I think China is super, super cheap. That 50% you talked about, it always happens right from the bottom, right? So there's a lot of things which are aligned for China this year. Geopolitical relationship suddenly is turning out nicely. COVID is behind us. The real estate, stimulus policies are coming back. Almost, I think I read somewhere that I think about 100 game titles are being approved. So tech regulations are easing. I think Ant Financial is coming back to IPO. A lot of things are happening in China. And somebody just told me yesterday that Macau is full. So you want to get a hotel room in Macau for Chinese New Year is 7,000 Hong Kong dollars, right? So the Chinese are coming back in a very big, revengeful way, spending. But it's going to be a bumpy ride. Investments are not coming back to China yet. Corporates are still very cautious. The real estate sector is still got a long way to repair and mend itself. So it's going to be a very bumpy ride, but I think the consumer wave is coming as a first wave. And I think China is, like what Tony said, it's going to be a very nice shock absorber to the world as the developed world goes into recession. And I think BHP made a comment this morning, I think, that China will help to cushion some of the slowdown happening in the developed markets. So China will be a cushion, which also means the global economy will not go into a recession this year. The Fed will not pivot. 5% interest rates, we have to live with it for a while.
At least you're consistent, Sylvan. Great. All right. There's some questions in the audience. If you guys can go into Slido, there's a lot of questions, and there is a function where you can upvote. So press the thumbs up to select the questions that you like most, because we're gonna go top down. The questions with the most upvotes will be answered first. US dollar. Any view on SGD versus USD? But maybe somebody can comment, maybe a macroeconomist, macro strategist, on the, you have the FX background.
Yeah.
USD generally, and then USD versus SGD.
Yeah, so generally, I think the broad dollar strengths are showing signs of peaking as well. There is definitely that overvaluation that has stretched for a while. And the supportive reasons for those overvaluation has been basically the safe haven trade and the yield differences. So again, these are narrowing or going to be a reducing force for the dollar's support. Also, I think we are looking at essentially what the dollar has done, the strong dollar has done, is to export inflation outside of the US. And we have also seen that in the Asia complex and also in the context of the SGD, that reserve managers and central banks have been supporting the local currency against dollar strength. And I think, in the light of 2023 and going forward, the primary reasons for dollars being safe haven trade and yield, strong yield carry trade, I think that will actually be a reducing force. And also the overvaluation and also the other emerging economies and China actually looking stronger, and Japan. So the yen is likely to be on a strengthening path, as well as inflation takes hold and the BOJ may have to eventually start hiking. I think that will be pushing the dollar to a lower level going forward.
Great. Robert, do you want to add, or there's other questions that you can answer if you want to?
Sure. I might just make a quick observation on the dollar. I mean, we also agree that the key drivers of the weakness that we've seen so far has been the rolling over of the US terms of trade. And we've seen the same picture in Japan, but their terms of trade has improved. So those have been the two big movers. And I think that the dollar is probably a useful indicator to watch in this environment, because, I mean, one interpretation is that the weaker dollar does mean there's less concerns about inflation, less concerns about a very painful global recession. I think if the dollar suddenly appreciates, that will be the safe haven flows coming back, and people might be really worried about a painful recession. So we kind of see the weaker dollar as positive for risk sentiment and global risk taking.
Great. We're going to answer one of the top question, which is what should investors focus on when a recession happens? But I'm going to tie that into another question asking about the 60-40 portfolio, because that's the hotly debated topic. Terrible 40-year performance last year. But maybe, Tony, since you grabbed the mic, go first on how do we position in a recessionary environment, and is the 60-40 portfolio still going to work?
Okay, so I mean, the classic answer is, right, you want to hold fixed income and you enter recession, the Fed will cut interest rates and all. But I mean, I'd say the real world answer is we're sitting here now. I think, all clients I talk to, everyone's waiting for the recession to buy equities. And as a matter of fact, I don't know, you all might be hearing from more fund managers than just myself, but I've been saying, I really think the second half is going to be the time to buy equities. And then the first question I answered was, I think equities are going to end up by the end of the year, though it might be choppy over the course of the year. But it does stand out that, boy, everyone's thinking this way. And I'm getting more and more concerned that waiting the second half might be too late. And so it's not the traditional answer to buy equities in the recession, but I think it's given the characteristic of, I think the likely recession that we're facing this time, like Christy mentioned, I don't really think unemployment's going to rise very very high. All the surveys coming out of businesses on will you be firing people? They're like, no, I'm more likely to hire, and I know things are slowing, but I still need more people. So this doesn't seem like a classic recession where businesses have overhired and they're going to have to fire lots of workers in a slowdown. So if it's a modest slowdown, ironically, I think the answer this year is buy equities.
The funny thing is, we were talking before this began with the next panelists, and they were saying how, oh, you guys are talking macro, so nothing to do with equities. So the disconnect between macro and markets is something that I think is a hotly debated topic. But if you look at the 12, 13 recessions that we've seen historically since the post-World War, there has been cases where we enter a recession and the market's already finished correcting, and we actually start rebounding. Like if you think back just 2020 COVID, the market was down 30% before anybody shouted recession. And when the recession actually began, we were off to the races. Obviously, there's monetary conditions and other factors. So, Selvin, with that in mind, what are your views and 60-40?
So I think 60-40 is not dead yet. I think it still has a role in investors' portfolios. In fact, I think today the bond starting yield is looking very interesting. You don't even need to go to high yield. You can just get 5.5% for IG. I think yesterday Woori Bank came out with a bond issuance. It was snapped up 16 times. It's crazy. We only got a very, very small allocation. So that's how hot the market is out there for yielding products. So I think bonds are going to play a very nice role into a 60-40 portfolio. In fact, I think last year's equity corrections reset valuations. So people like us, we do capital market assumptions 5-year out or 8-year out. The long-term capital market forecasts or returns forecasts are looking a lot more interesting today than 18 months ago. 18 months ago, if somebody asks you what's a 60-40, 4% maybe, because interest rates or yields were only like 2% or something, right? But today, I think it's looking very interesting. I mean, risk-free is running at 3.5, IG is running at 5, high yield 7, 8, 9, pick your number. And then equity returns are going to be somewhere in the region of maybe 8. And emerging markets are going to do maybe 9, 10. So it looks very interesting if you have a nice diversified portfolio. And I think today people are also starting to include liquid alternatives. I think there's a panel later. I see more and more asset allocators allocating 15 to 20% in liquid alts or private equities or fund of hedge funds. So it's something that investors should start thinking about. Yeah.
You were supposed to be the contrarian. You're sounding almost bullish. Okay, guys, we're gonna.
That's a longer term view. Yeah, this year is going to be a very, very tough
strategic view. Yes, not the tactical. Okay, we're gonna go around, guys, and share some key house views on asset classes you prefer and major predictions for the markets. It ties into a lot of the questions. There were questions related to, 3 people. Only Selvin was neutral. This person highlighted. Everybody else is optimistic. Can you share your portfolio positioning? What horizon is this based on? If you can go around, but someone touch on real estate, because there's been a divergence between private and public real estate, or listed or unlisted. And then gold was a question that also came up. So maybe if anybody has a strong view on gold, that would be really great. So I'll start. We'll let Christy rest for once and go the other way. Tony, Selvin, Robin, and then Christy.
Okay, so the broad views we would have is that one, we would start with fixed income as being sort of the win-win solution this year. Very unlikely to have a bad year. And so we're strong overweight, fixed income, both rates and credit. Then within equities, we're actually starting the year neutral. I think I mentioned by the end of the year, I think things can get better. And I
maybe too late.
Yeah. As a matter of fact, that's like our ongoing debate. Waiting the second half might be too late. Yeah. We think commodities end up better this year. That's going to be largely thanks to China. Let's see. Within credits, we're focusing more on investment grade. We think if there is a recession, it's probably mild enough that you don't get any investment grade defaults. High yield maybe gets more complicated. So high yield's performing, but we're being a little bit more cautious on that. We think the investment grade call is more of the clear one, and underweight the US.
Fantastic. Selvin.
So as I said earlier, we are neutral on equities. And on fixed income, I think we are extending duration already. So we think that that's a nice shock absorber to our investment portfolio. If we go into a recession and a deep recession, your long duration will come in as a nice offset to the overall portfolio. So we are starting to increase duration. We stick with IG. We actually cut high yield because we think that there will be defaults. Remember there's going to be a funding winter. And as the era of zero monetary or zero interest rates or excess liquidity, is behind us, we have to live with a new regime of tighter liquidity conditions or tighter monetary conditions, which means high yield will not do well. In fact, a lot of the high yield issuance should not have happened. Or sometimes even we think that some of the IG issuance should not have happened last year. So I think as the tide recedes, you will see a lot of dead bodies. So we are cautious on that front. Otherwise, we don't have a strong view on gold. And I think in a positive yielding environment, gold will not perform well. We also think that profitless tech, expensive valuations will not be in favor because we are living in a real positive yield world already. Just 18 months ago, we were living in a negative real yield world. So completely stay away from expensive things. Go for cheap things like energy, green transition, China, emerging markets, IG. Yeah, that's what we are looking at.
Great, Robert.
Yeah, so we are positive on China and Asian equities for all of the reasons that have been shared already. We're actually also positive on investment grade corporate credit in Asia for some of the reasons that Tony talked about, but also we are constructive on Asian high yield corporate credit, and that's largely because we do see some stabilization in China's real estate sector, and we do expect that to improve going forward, and high yield in Asia can get some benefit from that. I guess on the role for gold, we still see that as important because I guess going back to your known unknowns, the geopolitical risks is something that could come back again. And I guess, too, if the US dollar is weakening, then gold gives another alternative that, people want to diversify their exposure to that. So,
Okay, great.
Last but not least. Okay, so in terms of fixed income, I'm definitely still favoring IG, and potentially, I think looking at the first half, I'm of the view that you're probably looking at US Treasuries over equities first, and then hopefully it's not too late, and then risk appetite and risk assets are in favor. And in terms of equities, we do think that a lot of the things that we use definitely involve semiconductor. That's the left, right, center of technology. And a lot of the tech companies have been unfairly punished during the sell-off. So there's definitely values, and strong balance sheets is a key quality that we look for in those companies. And a lot of the semiconductors industries that we are looking at, like products or companies that help to enhance productivity, especially after the post-pandemic. That's still something that will be structural. And some of the companies and some of these shifts that are happening, I mean, if you look at advanced economies, they are already quite forward-looking and they are at the forefront. But the emerging economies are coming up with technology and advancements, and all this involve semiconductors. So that's kind of like where we think, whatever you do, whatever you use, are you gaming or not? You definitely have semiconductors at the center of it. And the other thing is that, yes, perhaps we still want to put in a little bit of a defensiveness into our portfolio. So infrastructure, and we're looking at still, inflation coming off, but still elevated a few times higher than normal. And that suggests to us that companies that are able to have pricing power, able to pass through inflation, and in terms of the infrastructure, the user pay assets that are going to still continue to have that demand. These companies continues to show strong balance sheet potential and earnings potential in the next few years, and that are our favorites.
Okay, great. Maybe if I can just add a comment on, I think one of the most important things this year is where US dollar is headed. Obviously it's impacted by inflation and interest rates in the US, but the US dollar is very, very critically important because it's the currency that a lot of assets are priced in, including gold. So oftentimes gold exhibits an inverse correlation to US dollar index. for obvious reasons. Commodities is priced in US dollars, so it often has inverse correlations. Emerging markets is very critically important and sensitive to the US dollar. In fact, if the US dollar weakens, that actually is a loosening of monetary conditions in emerging markets through the balance of payments mechanisms. So there's a lot of impact that the US dollar has. So I think it's important for us to look at the US dollar and what it does and how that has implications across multiple asset classes and geographies. But no one answered the real estate question. Who thinks Singapore prices, house prices have peaked? Put your hands up. Maybe the audience can put their hands up. Who thinks Singapore house prices have peaked? Rent prices have peaked and are expected to go down? Don't be shy. 2 people? Really? 3? Any comments on private versus public real estate divergence? Any strong views on real estate? You mentioned infrastructure, Christy, but...
Well, I think mostly that's referring to public sector and public listed and well, the kind of a pricing power that are available within the U.S. economy. As for this region, I think that's kind of also an attractive investment alternatives, and that comes under alts, and I think there'll be a lot more there. Yeah, so real estate will be amongst the alts, I think, one of the more attractive ones.
Great.
We tracked the global REITs, and I think global REITs did badly last year because of interest rates rising. But we also hear from some of the REITs players in the US that actually have pricing power. So they are raising rents for data centers, commercials, hospitality, student accommodation, so on and so forth. And the good news is that the funding is locked for 4 or 5 years. I think the same story for Singapore REITs. So the first part of the de-rating happened last year because risk-free went up. But then again, on the revenue side, it is actually kind of catching up quite nicely. So I think it's a good reset for valuations for REITs. I don't think it's going to rally in a big way, but I think the entry level is looking interesting.
Yeah. So I'd say, first thing, there are divergences around the world, right? So just to knock it off for the developed markets, it's all been driven by rising mortgage rates, and there's a big overhang. My view is actually that's going to start to ease, and it's going to give some relief to global property markets, but it's different than Singapore. So our models for Singapore are largely just driven off of supply and demand, and there's a supply problem, and it's not going to go away for a few years. So I would still stay bullish Singapore property.
And everyone's long property here. So, that's the bullishness. All right. Thank you so much, guys. It just leaves me time to thank the panel and for you guys for joining us. So thank you again.
Thanks.
Thank you, everyone. Thank you to the panelists for a very robust discussion on the state of the macro environment in 2022. Well, they've given you some house views, but that's still up for debate. And we have another panel that will actually deep dive into the equities market. So feel free to challenge the views from REITs to China equities. This is, again, your time. And I just wanted to prompt again that we are still taking questions across every panel. So now let's turn to equities in itself. We brought in an exciting lineup of speakers who will provide their thoughtful insights across different sectors. So first up, from Wellington, we have its head of multi-asset strategy in Asia Pacific. He conducts research on asset allocation, portfolio construction, and structural investment problems. And Nick has gone up on stage already, so please welcome Ms. Nick Simolian from Wellington. Next, portfolio specialist in the equity division of T. Rowe Price, who looks at global equity strategies on behalf of clients across Asia ex-Japan. Please welcome from T. Rowe Price, Rahul Ghosh. Joining them is our panelist from BlackRock with 15 years of investment experience. His responsibilities in the global real estate securities group includes covering property and infrastructure securities in the Asia-Pacific region. In other words, the REIT question can go to Ben. So ladies and gentlemen from BlackRock, Benjamin Tai. Finally, we welcome another seasoned hand to speak with us from Amundi. He rejoins the emerging markets team in South Asia following his role as head of research at Amundi BOC Wealth Management. Please welcome from Amundi, David Poh. And our moderator for this panel is our head of research, where she leads efforts by the Endowus Investment Office on research and content creation on the macro market and asset allocation, portfolio construction and optimization, and investment due diligence. She's a very busy woman. Here is Min Axiom from Endowus.
Thank you, Jamie. Can everyone hear me? Okay, cool. All right, well, I'm very excited to be here today with this group of very knowledgeable equity investors. So what we're gonna do is we have a variety of topics to cover because, as you can see, they all have different areas of expertise. We have 45 minutes, so we're gonna move really quick. Let me just get the first question ready. See, I think the first question is going to be really broad, and it's going to be directed at David. It's about 2022. 2022 turned out to be the year of the great repricing. Market valuations have come down significantly since 2021. But is this the right entry point, or is there room to go down further?
Oh, it's a very difficult question. Timing is always tough. For us in Amundi, we believe that fundamental research from a bottom up is always important. It's always difficult to time the market, but it's always easier to be in the market. So for us, any opportunity is always a good opportunity to accumulate, provided there are three things that you have to bear in mind. First thing is your horizon. If your horizon is very long, you have a long duration, I think slowly accumulating whenever there's a crisis is a good opportunity to start accumulating your wealth. That's one point. How long is your time horizon? Those with a shorter time horizon, naturally you have to bear the volatility in the market. Second thing you have to bear in mind is your risk appetite. For those who got very low risk appetite, I think trying to time the market is very difficult. Those who have a higher risk appetite, I think it's a good opportunity to re-enter the market. As the saying goes, don't waste a crisis. So what we've seen in 2022 was a good crisis. If you have a longer term horizon, you have a bigger risk appetite, I think it's good to start accumulating a bit by bit whenever the market falls. The third thing one has to bear in mind is your resources. A person with $100 million, he can accumulate, when the market drops, he can put in $1 million. He has the ability to withstand this. But a person who's got 100,000 in savings, trying to go into the market is very difficult. So you have to bear these three things in mind before you decide whether it's a good entry point to go in or not. I hope that answered the question.
Very comprehensive. Thank you, David. But because this is such an important question and the crux of why we're here, I'm going to open it up to the other panelists to see if you have additional questions. Who would like to go first? No? Okay. Right entry.
Well, I'll do a quick comment. I agree. I think there's something I read very wisely was put on something where if you believe in certain trends globally, these market dislocations, as long as something's not impaired, give you really good opportunities for medium-term investment. These dislocations, as long as the fundamentals are there, especially structural trends, you just build on that through time and you can benefit. And it doesn't come around very often.
The only thing I'd add to that is, look, there's been lots of research done in terms of the value of time in the market versus timing the market. I think what we've seen historically is, if you miss the best few days or weeks in a given year, your compounded returns in equity markets over the last, you call it 50, 70 years, you could miss out as much as between 2 to 5% on a compounded basis. So I think that goes to what David was saying, which is, timing the market is, yes, if you've got the time, the patience, the energy, and the capital for that is one thing. But over time, if you do believe that you're in the right investments, then the best thing to do is try to make sure you're consistently investing in them.
I'd just add, Tony made a point earlier about how I think there's a consensus growing that the second half of the year would be better than the first half, and that equity markets will go down and then go up. The question is, can you get that timing exactly right? And the answer is, well, you don't actually need to. you can try and avoid that by just investing. And if you think they're going to go up by the end of the year or over 2 years, then when you get in is less important.
Great, thank you. So this is what the experts have said, and what we at Endowus always say is just stay invested. All right, so going on to the second part, which is REITs, very important asset class, especially for Asian investors. I think somebody already mentioned in the previous panel that 2022 was a terrible year for REITs. The S&P Global REITs Index was down more than 20% and more than the MSCI Equity. So if we're going into this higher rate environment and that's going to be the new normal, what is your take on how REITs will fare in 2023?
Thanks for the question. And I feel like the last panel answered a lot of my questions in a positive light, so I feel like I can almost leave it there. But maybe starting with valuation. So we do see attractive valuations now. There's many metrics, but taking one that we're kind of more familiar with is a discounted net asset value. So in many markets, we're seeing that discount has pushed out, towards the 30% mark, which we've seen through historical basis. That's actually quite a nice marker of a rebound in the following 12 to 18 months. Now, I'm just not going to say what goes down has to go up. So there's more to it than that. There was a question around public-private pricing, and that's something that we have observed too. We do feel that, as a follow-on from that comment about the discount to NAV on the listed side, is that the implied pricing on a yield basis on the listed side is also starting to get quite a high spread versus the private side. Obviously, the private side tends to lag. I'm not saying that's a bad thing. It's just, it is what it is. So I think the listed side perhaps has gone a little bit too far. I'm not going to comment on where the private side might go from there, but I would just say as an absolute comment, I do see value in our space. The point about interest rates, I think what we went through last year was, as a fundamental investor, we go through this stage where, right, interest rates are higher. So what does that mean for our businesses? And the obvious first point is that it increases your interest costs. So as a fundamental analyst, it's very easy. We put those assumptions through. The other part is the discount rate has gone up, and that affects your valuations. So now you've got this clean slate coming into this year of you've done your interest rates, you've done your discount rate. So what we're now focused on is economic growth. And that, I guess, brings you to the outlook. So what do you believe on, and the other panel mentioned it about top line growth and the resilience of that. So, we come to elements of our market that we're still very positive on. We think the logistics market still has a lot of strength in there, not just because it's a very tightly supplied market, but you still have the growth of e-commerce. You still have, this trend now of re-onshoring or nearshoring, where supply chains are coming closer to markets that they're buying at, which requires more warehouse space. We continue to see longer term trends in demographics and aging societies that helps your healthcare sector. We still think, this question of economics is not something that we can ignore. We do see potential challenges on an economic growth cycle globally. Again, that's a global comment. There are nuances around the world. So, you think about what can be resilient in that space, and you think non-discretionary retail is quite obvious. We do like that space still. And I think there's a big question mark over office. But in listed space, you can be very targeted at what you want to do in the office space. And I think I'll just leave it as the broad comment that there is a push of flight to quality and a flight to ESG, i.e. flight to better spec environmental buildings, because that's going to be a regulation going forward globally that you can only lease buildings at a particular specification, especially in Europe. So I think I'll leave there.
Great. We'll definitely come back to the ESG bit later. That will be the second question. Okay, so Rahul is from T. Rowe Price, and T. Rowe Price has been investing in growth stocks since the 1950s. So I thought you'll be the best person to answer the next question, which is, it's about growth versus value. And I know Sam already covered some of it in his outlook. So growth stocks have done terribly in 2022. It's one of the worst years for them. What do you think is going to happen in 2023? Will values still remain in favor, or is growth going to make a comeback?
Sure. Thanks for the easy question. I think I'm going to preface by just talking a little bit about what our broad outlook for the markets is. So across the bulk of our global portfolio managers, what we're really thinking right now is that 2023 is likely to be really a choppy market. And part of that, there's a couple of reasons. Number one, as we've talked about on this and the previous panel, we haven't yet seen the full impact of what the Fed's been doing in the markets. Number two, there are real alternatives to equities, whether it's private credit, whether it's high yield, investment grade, etc. So the hurdle that equities have to surmount effectively are slightly higher. But in terms of value versus growth, we do think one, yes, there is a role for value to continue, especially because value does have sectors like energy, which could be linked to China, commodities, reopening trade, etc. Financials tend to do better in a high interest rate environment. But at the same time, we do think that there's a chance for growth equities to stage some kind of rebound in this year. And I'll really talk about that. What I've done on the chart, on the top chart, is just look at how the Russell 1000 growth and value indices in the US have done over the last, call it 20, 30 years. And what you really notice is that for an extended period of time to see value really outperform growth, you typically need to have a couple of things happening. One is you need to have a deep or protracted recession. And two, you typically need to see interest rates going up significantly. When we think about what's happening in the US today, our economists, kind of similar to what we were talking about before, we don't really see the sign of a deep recession because things like a credit bubble, what happened in 2008 or 2000, aren't really around for that. So while a recession is probably a high likelihood of happening, the deep recession may not be that case. The second thing is, when you look at that line of how interest rates have moved, whether or not the Fed needs to go from 4.5% to 5%, they're probably not going from 4.5% to 9%. So that move that you saw in rates in 2022 was a big impact on growth stocks overall. The second point I just want to make is when you look at what growth investing is, T. Rowe Price, Thomas Price, along with Phil Fisher, considered the fathers of growth investing. What they really always looked at is what is the growth in earnings? Can you invest in companies that can grow earnings and cash flow ahead of the market? And that's really what this chart shows you in the bottom right-hand side. Apologies if anyone's head's in the way. When you look since 1980 to 2022, sorry, Ben, in general, and you can run this over different time periods, the price return of the S&P for those last 42 years has been ballpark 8.5%, of which 6.4, 6.5 came from earnings growth. The rest was multiple, which typically tends to be impacted by interest rates. And that's what we come to. Growth investing, we think, over the last 4 to 8 years has been spoiled by the Fed. We look at growth and you see secular growth, i.e., long-dated, profitless tech, anyone that can grow sales at 15% a year for the next 25 years with zero profit margins was going up. What we think is the nature of growth investing and the focus is really going to come back to companies that can grow earnings ahead of the market, but that source of growth is probably going to come from other areas of the market. Could be cyclical names, industrials, someone else talked about infrastructure, could be defensive, healthcare, etc. But that's what we really think is the reason to think that growth could come back to some extent this year, but it's probably going to be driven by a different part of the market than what drove growth over the last 4 to 8 years.
Okay, great. Thank you. I didn't realize that there were so many flavors of growth, and thanks for coming prepared. I don't think you were expecting this question at all. So Nick, you are the asset allocation expert. So we can't move on from 2022 without talking about one of the better performing asset classes from last year, which is commodities, specifically oil. Oil was up last year, the first half of the year, and then it was down, and then it was up again, ending on a really, really positive note. And how should investors look at the sector in 2023? And how does ESG, oh, sorry, that's not, yeah. So we'll cover the ESG later, but go ahead, please.
I wouldn't use the word expert, but I'll take the allocation label. So it's tricky. There's lots of problems and changes going on with oil itself. And the first one to realize is that there is an important desire to decarbonize the global economy. And ultimately, that means that the price of oil ultimately should be zero in the future. And if that's the long-term goal, then it's hard to take long-term investment choices for that. But in the interim, you still need to use oil for many parts of the economy. So what you then have is a very constrained supply with a very strong demand occasionally. What that means is the price will move up and move around a lot. On top of that, you're getting a fragmentation in the global energy market, particularly around geopolitical concerns. And that means that instead of having a big global pool of resources to draw on, you're now getting different pools you can draw on with different pricing. So it's becoming a far more complex market, both in terms of volatility. The response of price to changes in demand is much higher. and it's getting a far more fragmented market in terms of where you can access the oil from and where you can sell it. So that's what makes it very, very tricky. The other thing just to keep in mind is traditionally there's been a negative relationship between a positive correlation between commodities and equities. They both went up when the economy grew. And there's some early insights that that's changing, that what's going on now is when commodity prices go up, central banks have to react to that by increasing interest rates, in which case equities decline. So from a portfolio perspective, any exposure to energy may well become more diversifying in your portfolio, albeit a little bit more volatile.
Great, thank you.
I will just add one more point.
Yes, please,
here.
David.
I mean, 2022 oil prices were down partly because the US draw on their special reserves and they were supplying oil out there. In 2023, the US is now trying to recoup back special reserves to top up what they have used last year. So the demand is definitely going to push up oil prices. On top of that, as Nick mentioned, there's a global economic growth now with China reopening. There'll be a stronger demand for oil. And therefore, our view in Amundi is oil prices is going to be higher from where it is today.
Thank you. And since you're also an expert in ESG, maybe you can talk about how, this focus on ESG and having oil-related exposure in the portfolio, how do you think about that?
ESG in Asia is still at its infancy stage. There are a lot of Asian economies still dependent on a lot of palm oil, for example, in Indonesia or in Malaysia. You have a lot of economies still depending on the suburban growth, and the environmental side will definitely have an impact if we're to strongly advocate on ESG. And we have seen what happened in February last year when the Russia-Ukraine war broke out. Europe suddenly turned to more dependent on fossil fuel because they are expecting a bad winter that happened that really did not materialize. How does it impact the portfolio? Those funds that invest in ESG underperform those funds that is non-ESG oriented last year, because fossil fuel prices goes up against those that don't invest in fossil fuel. But in this year, we think that the ESG funds will perform better. And also partly because we think there is a strong push towards this direction. The direction towards ESG is definitely very clear. We're in the right direction, trying to protect the environment, trying to give social and governance into the whole world. The direction is very clear, but the pace of the movement, the volatility of the movement is still to be seen.
Can I just, on that, because it's an important question and point that you raise, which is that when we think of ESG, they're not a single thing. And actually, it's very complex these days. And it requires lots of bottom-up analysis as you've gone through. Because if you just take the example that was used, there is an E concern around the oil price. You want to ultimately decarbonize the economy. But then also, there's an S concern as well, where you also don't want people to be cold in winter. So there's a social concern as well. And sometimes you need to balance those two out. And what they've done in Europe is done that. They've pushed out the long life of some of their coal and so on, because on the other side, they need to heat the homes. So this is an important point that needs to be managed very carefully. And I think many firms, including yourself, are doing a good job managing that.
Yeah, exactly. So E itself, the environment itself is so huge. You're talking about ice, you're talking about the climate change, you're talking about net zero, decarbonization, transition. It's a huge topic just focusing on the environment aspect. And as Lee correctly mentioned, you have to balance this against the social side. In, let's say, take for example, Indonesia, right? If we were to ban away, we were to say, take away all the palm oil, how are the Indonesians going to survive? Who's going to give them that kind of affordability for them to survive on a daily basis if they cannot depend on palm oil? So these are social concerns that we have to think about as we progress through this ESG development in Asia. As I mentioned, the direction is very clear, but the pace and the volatility within this space there's still a lot to be done.
Thank you very much. And whenever we talk about ESG, there's always very passionate views. So very, very happy to see that. Thank you. So actually, we talked about REITs earlier, Ben. And I know that you also cover infrastructure. So given that infrastructure equities posted attractive returns in 2022, do we expect to see the same in 2023? And like I promised, to further the discussion on ESG, could you also give us a glimpse into the future of green infrastructure assets?
Definitely. So again, there was a nice comment made earlier on infrastructure, and we agree with that comment by Christine. The previous panel, like last year, if you think about what listed infrastructure offered and even private is a high resilience of income. So if you think about where we think about infrastructure, utilities, toll roads, ports, transport, and even towers, and I can go into towers in a bit more detail, is that they are basically essential assets, and a lot of them have inflation-linked pricing as well. So, toll roads in Australia, there's an annual indexation. When you think about towers, how does towers affect our life in the infrastructure space? Every time you need to use your Wi-Fi, and you think about 4G, 5G, 6G, you need more and more of these towers. And these towers lease out to telcos, telecommunication companies on 10 to 20-year leases that are inflation linked. So you can see just that idea of the resilience of income, essential demand, and elastic demand. So I guess going into this year, there is that aspect that I would repeat is that, I get the sense that, yes, we are generally bullish on equities conceptually, but it's not without challenges, not without volatility, not without uncertainty coming into this year. We do think whether it's a technical recession, whether it just feels like a recession, whether it's just a slowdown, I think Europe's already kind of experiencing it. We do think US will have to experience something like it to get inflation down, et cetera, et cetera. So within that framework, we still think resilience of income matters. We still think that inflation protection matters, and it still has a very good place in the portfolio. When we think about other elements that we really like about infrastructure right now, we're talking about reopening. Transportation assets are a wonderful place to take on reopening. I cover airports. I've looked at different ones around the world, and they obviously had a very nice rebound. They continue to have a nice rebound in earnings and cash flow. So that's something that you can kind of benefit through this year. There are other longer term trends that we continue to like. We talked about kind of digitization, the growth of the digital economy, so towers, data centers, which kind of straddles both infrastructure and real estate. Again, continual trend. As well as the social side of things, urbanization, your continued investment in cities. But again, to your point about the green side of things, this is a very, very broad topic, and I think it's a very complicated topic, which is why it's nice that everyone, I think, has a chance to be invested in this journey, across many sectors. So just to break it down for us, if you take the Inflation Reduction Act in the US, it's just one example. Two things. It encourages, the development of renewable energy, but it also encourages the decarbonization of high carbon emitting sectors. And what does that mean? So you've got the investment in the renewable energy itself, and that helps infrastructure assets. It helps utility companies that have to develop renewable energy as well. You also need to invest in the networks that transport that energy from the source to users like you and me, or to the battery operator for your Tesla. That infrastructure is not so much in place as it is because there are technicalities around that power to transport. But the great thing also about decarbonizing other sectors is that it just increases the addressable market for renewable energy. So the more we drive electric cars, the more we want clean electricity. So the more you need to produce it. So it's kind of like, you need to kind of replace an existing fossil fuel energy source, and you need to do that responsibly because you just can't shut down coal plants day one. They have a purpose. But you also need, but what they're also doing is the users of that energy are becoming more clean as well. So you just increase the demand as well as the supply that's needed. So we like that kind of dual-headed benefit coming through our space, which will be multi-years to come.
Very exciting space, it seems like. Okay, so I think we've covered most of the asset classes here. The next part would be more on geographical opportunities. And I know the first panel covered this topic at length, China. Rahul, China has opened its borders again after 3 years. Do you think the valuations are attractive enough in China to jump back in, or are there more attractive opportunities in EM or other regions?
I think the term jump back in is always going to be sparingly applied to anything that's up 50% in a straight line. but there are definitely certain attractions there. So let's just talk about the broader EM versus developed markets, as was kind of addressed in the previous panel. Broadly, when you look at valuations, and valuations typically are a necessary but not sufficient condition for investments to do well, you do see that investment opportunities in terms of valuations, emerging markets are definitely cheaper than the US, and within emerging markets, China stands out. That just looks at the relative price to book versus the median since 2000. China is the lowest it's been at that point. India, unfortunately, is one of the more expensive EM markets on that front. But at the same time, we've all had that opportunity to go to a discount sale and buy something and you go home and it doesn't work. So we think you have to be more nuanced than just saying China or EM because it's cheap. And really, when you look at China last year, right, a lot of the pain was self-inflicted. We've talked about what is China dominated by, whether it's antitrust, regulation, picking fights with the US over accounting standards, picking issues with property. The property downturn was then exacerbated by the red lines with developers, etc. It was akin to asking the four of us to enter a swimming meet, but swim in our suits, right? And there was no hope of any of us winning that race. I think this year, China definitely has the opportunity to chart a different course. You've seen them, COVID reopening has been faster and earlier than anyone expected in terms of more pro-growth agenda policies, and they have a more benign inflation environment, which means the government potentially can do more to help the economy open up. But at the same time, I think we all know that you still live with regulatory risk. It was great to hear that you can have the number of games, etc., download, 10 gaming licenses go up. You wake up the next day and you read about the risk that China is going to take golden shares in companies that they deem important to the economy. So I think the way we look at China and the opportunities, say, got to distinguish between the big headline names that are in the index versus probably what's more attractive and real drivers of economic growth individually in the domestic economy. And the second thing, as I said, in emerging markets, when you look at it, many emerging markets in the region, Thailand, South Korea, ASEAN region, etc., have a very high beta to the Chinese economy in terms of the things that either drive Chinese domestic growth or Chinese exports, but you get them in some sense without the risks of overregulation. So yes, we do think China is an attractive place to be, but we think you got to be more nuanced than just saying China. Look internally, but also look for the second, third derivatives that people don't always necessarily associate with playing in China itself.
Great, thank you. Is China A shares or China ADRs?
Yeah, I think China domestic market is obviously there's a wider domestic base there, and I think you want to look the top 5%. It's a bit like the tech index where everything was dominated by likes of Apple, Microsoft, etc. Once you go below the 10 cents, Alibaba's, the JDs, you move out of the SOEs, right, which typically don't have high returns. Because my caution on buying things cheap is when you look at the price to book of China, what that doesn't show you on this chart is that as at an overall level, the return on equity for China has also trended steadily down over the last 7 to 8 years. Now, there's been a differentiation between big caps, SOEs, banks, etc., that are part of the index versus what's going below the surface. And that's really where we think you need to look.
Great answer, thank you. Any other panelists would like to offer comments on China?
I just offered two. One is, so I agree with all that, but just the two is, on the margin, there's discussion about deglobalization, and that means different things to different people. But I think one thing which is helpful right now is that as we're talking about the US going into a recession, or at least a slowdown, we're talking about the opposite in China. So in a portfolio where you want to have lots of things in a portfolio for diversification, China is something to absolutely look at. That's the first thing. The second one, I think there was a good point made about regulatory risk, but I think that is also a growing trend globally. I think governments are going to be intervening. It's not just a China story, it's a global story. And it's something we just need to get used to as investors, in that sometimes the aims of investors and the aims of policymakers diverge, and policymakers will increasingly change the rules.
Great. David, did you want to add something?
No, I just wanted to share the same point as what Nick mentioned, right? The regulatory risk is now spreading all across the globe now. You've seen what happened during Donald Trump when he became the president. There was a lot of regulatory risk, not only just on China, but it's actually spreading across. So the risk of geopolitical tensions is rising.
Okay, so optimistic on China, but maybe with some caution thrown in. Okay.
Yeah, we are positive on Chinese equities. when there are other places to play around, as what Raul mentioned, right? You have the Thailand, which is biggest beneficiary if China were to reopen, and Singapore too. I was in Bangkok last week for a presentation, and I went up to the hotel staff and asked the concierge and hotel staff, what is the occupancy rate? It's 99% full for the past month, this month, and the next month. So this is what I gather on the ground from the hotel staff, not from management, not from anyone. And this is what they say.
Impressive. All right, thanks for that story. So I think the last question here on my list, definitely not the last question for the panel, it's about dividends. So investors in Asia, as you all know, and the audience as well, are particularly partial to income-oriented strategies and investing opportunities. For investors looking for dividend plays, what are some key considerations to ensure robust income through equities? Nick, please.
I'll take a start at that. So one of the themes of discussion so far has been a potential disconnect. This is both panels. A potential disconnect between markets and the economy. The idea is that even if we had a slowdown in the US economy next year, the market could do well. Now, that isn't technically true also for dividends, because when you invest in fixed income, there's a contractual requirement for them to pay you the coupon. That is not true for dividends. When companies need the cash flow, they can easily stop the dividends. In fact, they often do. So if we do get into a more difficult economic environment, you could see dividends decline. So that's the first thing, is that we just need to realize dividend income is different from fixed income because of its contractual nature. The second thing is that means, what do you look for? And I think you want to try and get as much contractualness as you can. And there's two things that come out there. The one is there are so REITs as an example, where underneath the surface sits a rental agreement where there's a contractual need to get income. So that kind of source of income, I think, is useful. And then the other one is in a world where the macroeconomy is just more uncertain and costs are going up, firms who are much better disciplined at running their business and keeping costs under control will have a much higher chance of continuing to pay out. So probably that means, on the margin, quality as a style.
Great, thank you. So really income diversification sources too, like making sure you're diversifying your sources of income. Anything else?
Yeah, I just want to add one. I mean, it's not targeting REITs, but if you remember back in those days, during the global financial crisis, 2008, 2009, REITs were the one that raised a lot of capital. And if you don't participate in the placement of the capitals, you just get diluted in terms of your earnings and your income. So, as what Nick mentioned, dividend income may not be as secure as the fixed income from the bond side. So in Amundi, at this point in time, we much prefer fixed income relative to equities in terms of income space. This is how we look at it. For safety, we think that the 2023 is going to be a choppy year, but to be safe and to be conservative, a prudent way to play a strong cash income will be via fixed income, where you can get investment grade between 5% to 5.5% cash coupon yield, compared to a dividend income. They may not turn up, they may not be given to you, depending on how the environment is going to be like.
Yeah, I was just going to add, I guess, extrapolating on those two concepts you mentioned about contractual cash flows and quality. So when you dive underneath, the next level is, as you kind of mentioned before, interest expense. So we do focus quality not just in the fundamentals of a company and the stability of the operating environment that they're in, and obviously the contractual nature of the cash flows, but obviously the leverage as well. So we do believe that financial conditions are tighter this year. They were tightening last year, but we entered into, and I think the repercussions of that is one thing that we are just keeping an eye on. We don't think that while I think equity markets feel better, there's still a reality. And, infrastructure and real estate, we do use leverage. So one thing that we're mindful of, and you can be mindful of in your investments, is obviously looking at the leverage of the companies, because your interest bill is something that is coming. It may be hedged for year 1, year 2, but over the time, unless you think rates are going back to 2%, that interest bill will bite. And then, so that interest expense, the higher the leverage you have, the higher impact it's going to be at your bottom line and then therefore your dividends. So that's kind of just the offset that, yes, there's the top line stability. We obviously look through to the interest expense. We want the quality and the balance sheet to be rock solid.
I think just one other point that I'd like to add, the asset class comparison is great, but also when you look at equities, I think investors need to be cognizant that companies in different regions treat dividends or shareholder return very, very differently. So in the US, for example, right, they tend to focus significantly more on total shareholder return, and that is a component of dividends as well as share buybacks. There's tax reasons and other reasons for that. Typically, what they'll do is also set the dividend as a fixed percentage of earnings. So going back to what Nick was saying, if earnings go down 50%, your dividend typically will go down at least 50%, and who knows what the share buyback will do. What I've noticed is when, because I used to spend a lot of time in Europe, cover companies there, a lot more companies outside of the US, especially in Europe, tend to have a policy where there's a fixed percentage of earnings or a flat or stable dividend versus the last year. So I think when you add everything in terms of balance sheet stability, top line growth, safe company, quality, etc., but there's also a regional element that one needs to be mindful of, because the way corporates in Europe versus the US and Asia deal with dividend payout to investors is significantly different.
Great, thank you. Thanks for all the comments. In the interest of time, and we have a ton of questions, so I think we'll move into the Q&A portion of the session. So the first question, the one that's voted the most popular, is, if more volatile inflation and rates are here to stay, how should we think about stocks in the context of long-term portfolio allocation? For instance, should allocation to commodities and thematics replace the equity allocation? Who would like to take that? Maybe Nick?
Because it's a hard one. I'll start, and then I wouldn't replace equities with commodities. There's always a case to diversify, is the first thing I'd say. And if you are going into a world where the economy and inflation is more volatile, then things change. And I think one of the things that changes is that if you go back to just think of a firm, they need to grow their revenue. And now we're in an environment where the economy is changing a lot. So their revenue is going to be going up and down. And then their inflation is going up and down, so their costs are going up and down as well. So they're in an environment where actually their earnings and revenue, it's much more volatile than it was in the past. I think in that environment, what perhaps happens is investors start to focus on firms which are more boring and able to generate more consistent cash flow. Now, these are companies which were out of vogue. They weren't the ones that were growing 20% every quarter. These are the very boring companies that controlled everything. And I think in that macro environment, that particular type of company, call it quality if you want to, I think becomes very useful. I'll stop there and others will have comments.
No, I mean, almost exactly the same point. We've done some analysis. So when you look at the last, call it 25 years, and you break down performance of different types of stocks by growth, value, momentum, quality, etc., what's interesting is that almost every year, even if quality isn't number one, it's somewhere in the number one to number two. And it goes back to the environment, right? If you think over the longer term, you do have a inflation volatility. The trouble with commodities is that they're great in a bull market, but they're also companies that typically require lots of capex and heavy investments. So when that down cycle comes, your returns and your earnings also pretty much go through the floor when that happens. Quality companies, more consistent companies, tend to be slightly more capital light and capital efficient. So I think even within your equity portfolio, yes, there's a role for commodities to hedge against inflation in other areas. But if you really are expecting a very volatile environment, then I suspect you want to be biased a little bit more towards quality and consistency and capital light type of business models, because they can adjust the environment much faster. If BHP puts out an announcement today about a mine that's going to open in 2027, even if there's a recession in China and the US next year, they don't pull back that capex, but their return on capital, their return on equity is going to go from positive to negative over the next couple of years. And that's probably is not going to be a hedge in your portfolio.
Okay, great. Thank you. Thank you both. The next question, it's about technology, the tech sector. Should we wait for lower rates to reallocate to tech again?
For my sins at Tiro for also being the tech specialist, I'll start discussing that. But I think it goes to a combination of, I think it was Christy in the previous panel, as well as what I was talking about, which is not all tech is equal, right? Not all tech is high value, high octane, infrastructure, software as a service. There's basic tech that goes into, whether it's semiconductors, whether it's wireless, that all this is operating on. So I think with valuations have come in across different spectrums of tech. What we would say is generally what we want to try to look at, and same for any investor, is identify what we call linchpin companies or linchpin technologies, i.e. these are companies that are essential for the running of their customers and businesses, or companies that make the user experience significantly better, that even in a slow environment, we don't run away from them. And those companies may not be the Intels or the Microsofts that you hear about all the time. Think about the gold rush, right? The guys who made picks and shovels and sold them made a lot more money than every gold mine out there. So we think that in technology, you can't just wait. Yes, interest rates are what they are. Certain subsectors within technology have probably come back to levels that are pretty attractive. And I think we want to look for those that it's not just a fad, but real earnings, real cash conversion as well.
So
On that point, I just want to add that the tech, you have differentiate what is new tech and old tech, software and hardware. And for us, we truly believe, as I mentioned earlier, the clean energy, the environment, the ESG is here to stay. So this is one space that you can play in the technology space. In the solar energy, alternative energy, you can play from the upstream all the way down to the downstream, as he mentioned earlier, right? New energy, you can consist of polysilicon, equipment manufacturers, you have the panel manufacturers, you have the tower manufacturers, you have so many areas that can play entire vertical whole supply chain. So depending on the cycle, depending on where you want to be involved, you can participate in this new tech area. Storage is also another area that one can participate as well, where you have electric vehicle. Instead of charging it, you can replace or rent a battery to replace your existing battery in your vehicles. So instead of wasting 1 hour at the charging point, you can go to a place that can rent your battery, replace with your existing battery, and off you go. Things like this are still playing out in this space.
Great, thank you, David. So, sorry, Nick, maybe the last question first, and then if we have time, because I think we're running out of time, but I really want to highlight this question. Given what the macro panel mentioned, is Singapore REIT a defensive allocation for income and capital gain? And this one will go to Ben.
Did you say Singapore REITs or Singapore?
Singapore REITs.
REITs. And I'm the specialist on the Singapore REITs as well, so I actually have a very dynamic answer. Probably too much in the weeds. What I would say is yes, it's a fairly resilient sector in terms of the economy, the top line growth. The leverage is a little higher when I think of a global perspective. You might not think, if you have a narrow focus just on Singapore. Singapore REITs do tend to have leverage. When you talk about leverage in this respect, let's just talk total debt to total assets. Somewhere closer to that 40% range. If you think about globally, Australia's around the 20s, America's around the 20s, and Europe's a little higher, and Japan's very high. And that's a whole nother kettle of fish. So what I would say is it is stable. I do think that your DPU growth is probably going to be a little challenged over the next few years. People always say, well, my interest rate's hedged 80% this year. I said, yeah, but when you look at forward rates, not to get too technical, forward rates imply that rates are higher than what their in-place debt is today. So there is going to be upward pressure on their interest rates for the next few coming years, just as they roll off. But they will also get top-line growth. So we don't see it as, I guess, yes, to your point, there is a place for stability there, but I wouldn't say there's quite a lot of growth there, just because of that dynamic of that higher leverage that you can't really avoid. But there are some REITs that are lower levered, which will benefit. I'd just be very mindful of ones that are very highly levered, because we are entering into a cycle where asset valuations might have a bit of pressure, and you just want to make sure that your REIT doesn't have any problems on that perspective.
Thank you, Ben. Do we have questions for just a comment? Okay, so maybe Nick, did you want to add anything? Did you have a comment?
No, it was on the tech, but we can come back to another question.
Oh, I think that's it. We have all the time for. So if you want to just go ahead. And
just to reiterate this point about tech there's different parts of tech, and it seems strange. If you cast your mind back just 12 months ago, you had companies which they were committed to changing the world in some way, and they never spoke about profit. What they spoke about how much they were growing very quickly. and they weren't covering their costs, which didn't matter because they could borrow effectively at zero to cover the costs. And it's no surprise that when interest rates have gone up and the economy is slowing, that those tech companies have come under strain. But then there's other companies who are much more disciplined and are run in a way that they can survive high interest rates and are involved in structural change. We are changing the way we are living and working. So tech is quite different in different parts of the sector. And there are certain parts of the tech world which I don't think will ever go back to their previous highs. But there are others which I think we may well, at the moment, be in a soft spot, but I think are longer term, again, something to think about.
Great, thank you. And I think that's all we have time for. So thank you, panelists. You guys were great. And thank you, audience.
Thank you, everyone. I'm sure you've come back with a lot of investing ideas that you might want to discuss over some coffee and snacks. So for those in the audience, it's time to be able to stretch our legs. We have some refreshments prepared outside, just outside at the foyer. If you just head outside, you'll be able to have a look at that. And the next panel will start at 3:30, so we'll see you then. Ladies and gentlemen, welcome back to the second half of our panel session. Earlier this afternoon, we went through the macro environment. We've also went through a deep dive into the equities market. And to kick off the second half of the event, we are diving straight into perhaps the trendiest asset of 2023. And I will say so because I'm moderating the next panel, so I'm just going to hype it up a little bit. This is on bonds. The fixed income market, of course, in 2022 had a difficult, shall we say, year in possibly in 40 years. But 2023, with the rising rate environment, it's probably opened up one of the biggest rush in interest in income yielding instruments. So will this be the best year yet for bonds? And I'm very privileged to have an esteemed panel to join us and to share their insights on the fixed income market. So let's first welcome our panelists from PIMCO. With 18 years of investment and financial services experience, he focused on emerging market corporate debt as a portfolio manager. From PIMCO, please welcome Abhijit Neogi. Next up, our panelists from JPMorgan Asset Management. More than 2 decades of experience in the asset management industry. He heads up the Asia ex-Japan team of investment specialists in the global fixed income, currency, and commodities group. We're pleased to invite on stage Jonathan Liang from JPMorgan Asset Management. Last but not least, we're pleased to have our panelists from BNY Mellon, 25 years of experience in the financial services industry. So all of you will be in very good hands in the fixed income panel. Please welcome Head of Asia Macro and Investment Strategy at BNY Mellon, Aninda Mitra. Thank you, gentlemen. So I assume with 2023 starting, your chests are a little bit higher, your head are a bit taller in 2023, because I think bonds has been quite an interesting asset class in 2023. And of course, we've seen quite a rush of interest in these income yielding instruments. Now, I just wanted to start first with the first big question, right? So we've gone from TINA, there's no alternative, to BAR, bonds are back. So how should investors think about the opportunities for bonds in 2023 after its possibly worst ever performance in 2022 to start off? Ninda, please.
Sure. Can you hear me? Yep, good. It's been a phenomenal year. So, 2022, it's rare in terms of the degree to which both equities and fixed income have sold off. A 12 or 13% drop in bonds is not only a very rare event. Do I have the slides here? The slide on the chart on the right basically shows you that it's very rare to see both equities and bonds fall off as much as they did. And the extent of the drawdown in the bond space is also almost unprecedented going back to the 1970s. So clearly, if you believe that this is a rare event and lightning doesn't strike in the same place again, that should tell you something about the way bonds should perform this year. We are constructive on bonds versus equities as well. That's a slide on the left. Again, if you just look at the returns of the of stocks over bonds and map that out, stocks don't do very well against the bonds going into a business cycle slowdown. And the way we are portraying this is by comparing that against your ISM manufacturing PMIs. Now, we are expecting a slowdown. Just to provide a little bit of context, at BNY Mellon Investment Management, we try to work through a set of scenarios to come up with a view on how asset markets are going to behave, rather than depending purely on point forecasts. And the way we see things is that there's still about a 60% odd chance of a slowdown or a recession or a prolonged patch of below potential growth, a 30% chance of a soft landing where supply side conditions improve quite dramatically, and possibly a 10% chance of something breaking, given the degree to which the Fed has hike rates and could keep rates elevated. So considering the unusual drop in prices in 2022, the rising risk of a slowdown of some sort, and the fact that inflation's beginning to turn around. It's not spiking anymore. It's still a long battle ahead. So in all of that, I think that the case for bonds is certainly very strong. We particularly like DM fixed income sovereign bonds, which seem to be the safest bet going into what is still a very uncertain environment. I think there's still a lot of questions about the outlook for inflation. Is it really rolling over? There are structural issues in the labor market, not just in the US, but in many developed economies, with labor supply not really coming back after COVID as much as things used to be before COVID. So that's kept wage increases quite high. Again, one could point out that those are also rolling over, but they could stay elevated for a long time. And that could require a more hawkish response, not only from the Fed, but also from the ECB, and therein lies the rub. I think, and that's what keeps us focused on the safer parts of fixed income. DM fixed income, sovereign bonds. If you're getting into the corporate space, we are suggesting high quality investment grade type of sectors.
Are you expecting, a lot of the earlier panelists have talked about disinflation and the fact that you need to see significant disinflation before, you can move and see less volatile times. Is there a range in which you're looking at, or there are particular factors that you're looking at, before you're seeing more certainty in the market?
So it could play out in one of two ways. You see, or both, you see a lot of disinflation, or you see a lot of earnings pain in the equities market space. So those would be catalysts possibly for seeking, refuge in bonds. I mean, we're anticipating that, and hence we are suggesting to be exposed to the space. But if you also have a miraculous disinflation brought on by a pickup in labor supply, slower wages and that sort of thing, which is something we assign a lower probability to. People have talked about labor force recovery in the US and a higher labor force participation rate and so on. Those have taken a long time. They're not back yet. So there's two ways this could happen. And we're saying that the former, which is the economy slows down, earnings feel more pain, could drive more refuge into the safety of fixed income.
Jonathan, over to you. Where will rates land in 2023? And of course, Aninda has mentioned a little bit about that. And the more salient question, I think, is the central bank telegraphing the right signals? We know that there is a bit of a game of chicken between the markets and the Fed today. So should investors expect more volatility, or how should they think about this period in which the markets and the Fed are currently not in agreement?
So we think that we're entering a phase where the upward pressure on treasury yields is going to come off a bit. Now, at the beginning of the year, our forecast was for 10-year treasury yields to hit a range of between 3.5 to 3, and it got there a little too quickly for us. So it's now at 3.3, and so it's a bit of a conundrum in that I think on a very short-term basis, we feel that the market has gotten a little ahead of itself. But we do think that the trajectory is for yields to drift lower this year, and that's because of the framework that you see behind me. So this is a framework that we had created in 2018. And why 2018? Because if you look at the stocks and bonds returns, a lot of people feel that 2022 was this anomaly where stocks and bonds fell at the same time for the first time, kind of like ever for the last 4 decades. But that is actually not quite true. We had a bit of a dress rehearsal where stocks and bonds both sort of fell at the same time, and we had wrong way correlation in 2018. And so it wasn't nearly as dramatic as 2022, but stocks and bonds did sort of see positive correlation on the downside in that year. So what's the commonality between 2018 and 2022? The answer is that both those years, the Fed was transitioning from a period of quantitative easing to quantitative tightening and rate hikes. And when that happens, you get that wrong way correlation between stocks and bonds. So this is what the framework is trying to show you. We clearly went through phase 1 in 2022. That is the period what I described just now, where the Fed transitions from a period of QE to QT. And in that period, treasury yields sell off, stocks are weaker, credit is weaker, volatility is extremely high. We get what we call wrong way correlation between risky assets and risk-free assets. Now, the good news is that we think phase two is next. Phase two is the green box in the middle. And that is when the Fed is still tightening, but that tightening is now finally slowing economic activity, slowing inflation. And that's when a period when you can see bond yields drift lower, even though we think that risky assets like equities could see heightened volatility. But at least now you get right way correlation. Bonds once again act as a ballast to windward. So that's what we're expecting this year. When we get to a stage where, bad news is bad news rather than bad news is good news to the markets, that's when we think that bonds can once again become that diversifier to the risky parts of your portfolio.
If I could just add one, question to that, I think in the Bank of Japan, we focus a lot, very much on the Fed, but I think Bank of Japan this week did surprise the markets on not moving on its yield. And the way to explain Japan is to talk about Uniqlo raising 40% of wages, right? To understand that Japan, a country that apologizes for raising prices on 2 yen, right, is suddenly seeing inflation. And so there is also some concern about what that means in terms of volatility in the markets as well. And I just wondered if you could comment on that.
So in our unconstrained fixed income strategies, some of our strategies currently is contemplating how to capitalize on the eventual give up of yield curve control by the Bank of Japan. Our economist was not expecting a give up yesterday, or was it the day before? The thing is, because it was more a political consideration, because Kuroda, we felt that it was politically not so good reflection on Kuroda if he were to change the policy, give up yield curve control right before his term ended, and the new successor was sort of like, foisted this new policy on him or her in their next term. So we were not expecting a dramatic change yesterday, but the market was. And so we saw quite a bit of market action overnight and yesterday. We think that actually the way to, at this point in time, we think the way to capitalize on it is actually to be long the yen rather than short the government bond. And we think you get the more bang for the buck from doing that. Now, is it going to cause a lot of volatility when they actually give it up? We don't think so necessarily, especially if it's well telegraphed. And we think next month we may start to get clues about who's going to be the next governor. And depending on who him or her is, we're going to get some clues about the future policy framework of Japan. So we're not expecting a lot of volatility to emanate from the eventual give up of yield curve control.
Thank you for that. Abhijit, the Fed rate hikes are of course setting us up for a growth slowdown. Of course, Jonathan did mention that. How should bonds perform in all different scenarios of recovery and growth scenarios?
Thank you. Yes, an modest economic slowdown is something in our base case as well, because the central banks continue to fight inflation. Financial conditions will continue to be very tight as the central banks have telegraphed to the market that they intend to keep rates higher for longer. And because of these higher rates, we could have a modest recession, but the recession could be prolonged because the rates could be elevated for longer than what the market is expecting. So with this backdrop, what we have seen is that in 2022, we had one of the fastest or the largest increase in real rates in 4 decades. And the only positive side that came from the pain that we endured in our portfolios last year is that we start this year with pretty attractive yields and improved prospects of generating attractive returns. So fixed income instruments now give you a decent all-in yield, as well as in case the recession turns out to be deeper than expected, you get good protection against the downside. That's why, as some of my fellow panelists have talked about, we also like good quality investment grade or even core US bond portfolios. Now core US bond portfolios are giving you anywhere from 5 to 5.5%. And if you add a little bit of higher quality credit to it, you can enhance the yield even more. And these things will probably be a lot more resilient, say, compared to equities, where we feel that the earnings revisions, etc., have not reflected the fact that we might be heading into a recession. If we look at the equity risk premium compared to past 10 years of history, we are still somewhere towards the higher end of, as in like the equity risk premium is on the lower side. So that's why I feel that the bonds are in a safer place to be. But like some of our fellow investment houses, we not only look at the base case, but also look at few different scenarios and how asset prices would react in different scenarios. And in case, for example, the recession is less deeper than what we think of the market, and we think corporate bonds, especially the IG corporate bonds, could do very well. Also, other attractive place could be the TIPS market or the inflation protected securities, where we think that the market, what the market is pricing in versus where the inflation comes out to be, and while the base case still is that we'll probably have disinflation and we will moderate closer from 8% to 4% and then stay frustratingly at a higher level. But in case it comes out to be stronger or inflation is a lot more stickier, then these could give you some upside. But at the same time, what we have to emphasize is that in our portfolios, we are keeping some dry powder on the side. We think there could be still more ups and downs, as there's still a lot of clarity that we need on the economic outlook. So that's how we are thinking in terms of having higher quality bonds in the portfolios. And then there are other parts of the fixed income universe, which I can detail further if there's interest on what portions we like within the.
So I think there will be questions. And again, please send over your questions on what particular sectors you're looking at, and we can certainly address them. Maybe Ananda, thinking about duration exposure, how should investors be positioning on that front?
Yeah, so I think there's still some lurking inflation uncertainty out there. I think there's a lot of people in the equity market space who've tried to stage what clearly seems to me to be a bear market rally, and it's been knocked down repeatedly. A lot of that has to do with inflation and ultimately the Fed's views about what needs to be done. So there's a bit of a disagreement in the market in terms of what the Fed funds futures market's pricing in a peak at around 5% and then rate cuts by the second half of this year. I'm not so sure the economy tips into a recession strongly enough or inflation comes off that sharply where the Fed starts to consider rate cuts. So they've been signaling that they're going to go higher for longer. I'm not saying they'll go 50 bips or 75 bips anymore. The jumbo rate hikes are behind us. But there's a sufficient degree of uncertainty with inflation, which keeps the Fed dot plots quite a bit higher for longer compared to what the market's been anticipating. So my preference would be for not be too overextended on the duration side. If in case inflation doesn't come off as the market's been pricing in, if you look at where break-even rates are, break-even inflation rates are, or swap rates, again, those are very optimistic right now, 2.5%, whereas realized inflation is still pretty high. If you look at household survey-based expectations of inflation, which are still, the Michigan expectation in the year ahead or so are in the 5% and above, and wage growth is still quite high. So the acceleration is not continuing anymore, but the level of these rates are still very high. So that's what keeps me a bit cautious. The disagreement between the market and the Fed isn't there yet. It hasn't been resolved yet. And we haven't seen the earnings pain yet. I think that's still yet to come. And if you do a simple model of earnings, based on ISM and CEO confidence levels and so on against actual forward earnings, I mean, there's more downside to go. That's the chart on the left. So, yeah, don't fight the Fed and be aware of the earnings whiplash.
And for Jonathan, I think since there are probably some questions about that, which type of bonds are in favor by sectors, markets, or credit type? Just elaborate a bit more.
So currently, broadly speaking, fixed income as an asset class, the risk return profile has improved dramatically after the repricing that we saw last year. And just to dimension what I mean by that, the chart on the right-hand side is different fixed income sectors, and the blue line is your 1-year forward return if the yield in that particular sector drops by 1%. And then the gray line is what happens to your 1-year forward return if yields go up by 1% in that particular sector. So as you all know, there's an inverse relationship between yield and bond price. So yields going up obviously is not good for bonds. But you can see from the chart, the blue lines are much longer than the gray lines now. And so that's why people are saying bonds are back, because income is finally back in fixed income. And so your starting yield to maturity is usually a pretty good indicator of your likely future returns. And so, like, for example, if you take a look at high yield on the right-hand side, that's the 5th row from the bottom up. If yield spreads were to widen by 1% from here, then you still make 5.5% because we're starting with 9% in the high yield market in the US today. Conversely, if spreads were to compress 1%, which is unlikely, we actually think, you make 14%. But that probably won't happen in this year. But we actually expect spreads to widen. So we do have some high yield in our strategies, but we have put on a CDX hedge on it that if spreads were to widen, that hedge would make money. But where we are a bit more optimistic is so we talked about how rents are still very high, right? The shelter component in inflation is still pretty high. That's bad for inflation, but is very good for multifamily CMBS, commercial mortgage-backed securities. So multifamily CMBS essentially is just mortgage loans taken out by property developers that develop these properties just for rent. And because rents have been rising, they are very, very profitable. Their operating earnings today is much higher than it was 2 years ago. And as a result, the value of the property portfolio is much higher today than it was 2 years ago. So the credit risk has dropped quite a bit. And depending on the tranche you buy in the CMBS, you could earn up to like 8% today. So we think the risk reward in the fixed income markets is broadly better today, and there are some interesting pockets of opportunity in CMBS, in local currency emerging market rates, where central banks there in select countries like Brazil, they have very high real rates, and as inflation rolls over, they may be even ahead of the Fed in terms of their pivot. And in addition, the long dollar trade might be over, the dollar rally might be over, so there may be some select opportunities in the local EMFX space as well.
Maybe if you could take that as well. I think there's a lot of interest about EM debt, so feel free to elaborate on that. But also, what are some sectors, markets, credit quality to avoid?
Yeah, I mean, going into a recession, we want to avoid those sectors which could be hurt, or you could have principal loss in these sectors, especially things like pharmaceuticals, where you have some litigation risk, things like some parts of technology where you could have more shareholder-friendly activities like M&A, dividends, retailers, which are structurally, which have given the move to online shopping sector. Some of these retailers could continue to be hurt. But within different asset classes, where we are cautious is generally the secured loans, which have a floating rate component. For the first time in history, the coupon on these floating rate loans is higher than the fixed coupon on high yield. And a lot of these companies are smaller companies which did not have access to the high yield market. They went straight to the loan market, and that's wherein is the rub. While these floating coupons protected investors on the upside when the rates were going up, but now the interest cost is very high for some of these smaller companies. A lot of these were done as covenant light with limited covenants. Also, there were also a lot of them where there's only loans in the capital structure. There is no high yield bond, etc., which is subordinated to these senior loans. So that's a place where we are quite cautious on. In the high yield space, again, we want to avoid some of these cyclical sectors, which could, especially if we see a much deeper recession than what we are forecasting. Just to add a little bit on what we are liking, we talked about the high quality investment grade bonds. That's definitely something that we like. We like sectors like wireless, tower companies, etc. Things where they can pass the high input cost to the consumer. And the ones where there is lack of pricing power are the sectors we want to be a bit cautious on. In the US housing market, that's been a topic of discussion given the sharp rise in mortgage rates, etc. There's one differentiation that we'd like to make. There's a difference between companies or sectors that are exposed to the flow versus the ones that are exposed to the stock. What I mean by that is that US housing prices went up 40% from pre-pandemic levels. So there's a lot of equity, home equity in these homes. So US agency and non-agency mortgages are now quite, because of the amount of equity that's underneath, are pretty robust right now. And while a lot of people might want to compare this versus 2008, the key difference is that you don't have these weaker arm structures or these teaser structures that you had. So the underwriting standards were a lot better. The other thing is the US pretty much underbuilt for a complete decade. So the inventory is only like 3 months, whereas in normal market, it should be around 6 months. So that protects it. The other thing is 95% of the US mortgage is fixed rate. The mortgage rate went as low as 2.8% before going back to 7%, but most of them refinance it and have fixed mortgages for around 3.5%. So as a result, you are not going to see these people sell homes at distressed prices, etc. So we feel some of these agency and non-agency mortgages are looking quite attractive. And then lastly, on emerging markets, similar view as Jonathan. We think that the high real rates in some of the EM economies do give us a decent buffer in case the Fed was to continue on these hikes. But we do think that the jumbo hikes are done with, and inflation, if anything, should start coming off. And given the high real rates, some of them could pivot earlier. And then with the dollar coming off or flattening out, at least not having the spike that we had last year, emerging market local debt looks quite attractive.
Are there particular markets that you'll be looking at? Just in the emerging market space?
Yeah, so as Brazil was definitely everybody's favorite, of course, with Lula coming in and talking about his social agenda. But South Africa was a decent, near to home. Indonesia has been, the economy has been transforming. It is a big commodity producer, especially commodities related to the EV supply chain. So, and then given the higher real yields, or higher level of yields, and the currency being quite decent carry, we like those markets.
Anyone could take the question on China debt. Is anyone keen on China debt, neutral, underweight?
We have an underweight,
comment?
yeah. And again, it is probably it's more of a tactical kind of view, but it's mostly based on the fact that it's going to be an economy that's opening up right now. So there are other parts of the capital structure, especially equities, etc., which are attractive, or even some of these credit. I manage a high yield credit fund, so those are much more attractive than the government bonds. There could be some inflation as we are coming to the end of the low prices in the pork cycle. We could have some of the inflation come back there. So within the opportunity set of China, we think equities and credit provide you probably more potential upside.
Would you like to hesitate?
Yeah, I think the market will at some point start to price in rate hikes from the PBOC. So in anticipation of that, we'd certainly be short CGBs as the economy recovers very strongly. We're projecting something like 5.5% growth this year. It remains to be seen the degree of further fiscal support for the economy, because the question that everybody's asking right now is the drawdown of excess savings. What's piled up from the lack of spending from last year and how much of that will actually get spent. There's all sorts of estimates out there. There could be something like 10% of GDP in unspent household deposits that have piled up in the banking system. I'd be a bit more cautious about that, because a lot of that money would typically go into housing, which is a savings vehicle, right? So if you're afraid of a market downturn and you've uninvested or not invested, it doesn't mean you're going to spend that money because the restrictions have eased. So we are applying a discount factor to that pileup of savings, but even so, you still get something like 5.5% growth this year. It would have been even stronger were it not for a global slowdown and a downshift in exports, which we are penciling into the growth forecast for China, as well as outbound tourism. That's a net import of services, so it will detract from Chinese growth. So all in all, it's still a very strong growth result. Inflation will pick up. The PPI deflation has ended in China. It's starting to hook back up. It's still below zero, but it's picking up. And that will have a global price impact as well, because what happens in China, at least on the producer side, does impact global prices. So that's something to keep an eye on. With a lag, of course, it'll affect the goods price disinflation that you're seeing so far this year, which has been the main driver behind pulling down DM inflation, will at some point start to stagnate, if not downright reverse. So when the market starts pricing in, something of a normalization out of China, it's the only central bank which hasn't normalized. Even the BOJ has pivoted, as you were pointing out. So yeah, that's coming, and we'll be short CGBs.
I expected this question to come out. So, Jonathan, if you could take this, what's your view on Singapore treasuries or T-bills?
Well, Singapore treasuries. So Singapore to us is more of a safe haven asset class. Certainly not an emerging market, and so we think that in an environment where the global economy is slowing down, that Singapore government bonds could provide that sort of safe haven ballast to windward effect, similar to U.S. treasuries. So we would view Singapore government bonds as serving that kind of role in people's portfolios.
Okay. We have some questions on the U.S. dollar, and I think maybe Jonathan can also take this. I think the question is really about the impact of the U.S. dollar. The trade on the long US is fading off, and what impact does that really have on the EM market? But if I could combine that question, somebody has asked, between EM and DM over a 10-year horizon, which one should you buy? It's a difficult question, but I just wondered if you could provide some perspective on this, on how they should be positioning themselves.
It depends on your risk tolerance, right? So I think if your universe, I think EM should not be viewed as sort of, EM and DM shouldn't be viewed as either or. I think there should be some allocation to emerging market debt. As Abi had just talked about, local rates looks interesting, given that many EM central banks likely could potentially pivot this year. But it's just one part of your portfolio. Developed market bonds right now are trading at, for the first time in a long time, they have positive real yields. And so we saw earlier in my chart that the risk return in which was largely developed markets looks very interesting right now, the risk reward. So I wouldn't say DM versus EM, but you should consider owning both in your portfolio for diversification purposes as well as income generating purposes.
We have also one question. I think it's specifically on the JPMorgan 3 phases model, but I think the question is really talking about how long would recovery take, and what is your expectation, I suppose, of
recovery
in terms of how long, if we could flash the slide back to the, I don't know if you're able to flash it back to the three phrases that we have. Are we able to get that?
Slide 8.
Sorry about that. Yeah, so I think they're trying to ask how long would phase 2 go on for before phase 3 happens, if I'm sort of reading that. How long is the second phase expected to stick around before phase 3 starts? So apologies for that.
So that really depends on what happens to the economy. So there's no set duration or timing of how long these phases are. It really depends on what is happening to the real economy. So, you know, if we get a Anina was just showing you a chart of that the market right now is expecting a Fed pivot this year, right? So if that happens, then we may be going straight to phase 3, right? Because that phase 3 is when the Fed capitulates and goes from hiking or pausing to pivoting and cutting rates and start reflating the economy again. And in that environment, risky assets like stocks do better. And interestingly, the long end of the yield curve actually sells off because when the economy is recovering and growing and being reflated, the US yield curve will steepen. Currently, it is inverted, right? Because it's pricing in a recession. So, however, it may take a while because in my opinion, the Fed is still haunted by the ghost of Arthur Burns. And who is Arthur Burns, you might ask? He was the former Fed chair of the Federal Reserve during the 70s. And he had been under tremendous political pressure from President Nixon back in the day because he wanted to get reelected. So he didn't like the Fed to hike rates to fight inflation. He wanted him to focus more on the employment mandate rather than a price stability mandate, the dual mandate of the Fed. So what happened was, as soon as inflation data started rolling over in the 70s, he then immediately cut rates. But that only reignited the next round of inflation in the US. So if you look at the Fed funds rate history, during the 70s, you see this sort of wave of Fed fund rate hikes and Fed fund rate cuts. And it wasn't until Paul Volcker came along and hiked Fed funds rate to 20% that it finally nipped inflation in the bud. The Fed is very aware of this history. Chair Powell actually made reference to it in Jackson Hole last year. And so because they're still haunted by this memory, they were going to try their very best to pause and hold on to that 5% terminal rate for as long as possible. But look, if unemployment starts to pick up, growth slows down, inflation rolls over, you know, what are they going to do? Keep in mind also that this is the same Fed that told us that inflation is likely transitory in 2021, right? So you know, we think that there is a chance that we might start to see pivot potential towards the end of this year.
So, Aninda, were you ever convinced that it was transitory?
Well, hindsight is 2020, right? So, look, I like the history lesson of going back to the 70s. That's a useful perspective to keep in mind. But the pause in Fed policy, I mean, you see that coming out of every Fed governor's, comments in the press and so on. And the markets still try to second guess them. So that's what I'm concerned about. That battle between the Fed is not over yet. Yes, they may not be, we're not looking at 15% interest rates by any stretch. The difference is, will it be 6% or 5.5% is enough? There's not much further to go considering they've already moved 400 basis points, right? But the real battle will be how long does it stay at 5 or 5.5? Clearly, they're not going to be, I don't think they will cut from June or July onwards, which is what the Fed funds futures market's priced in right now. So yeah, it could set the stage for some volatility even in the rates market, And yeah, we were talking earlier about the BOJ. If the YCC does get removed, there'll be a bit more volatility. I'm not concerned about a massive, giant sucking sound of capital coming out of the rest of the world, frankly. I mean, I think at the end of the day, normalization is important for Japan, given where inflation rate it amounts to resetting to a higher level of the inflation rate and responding to the dislocations in the domestic bond market. But the reason I bring that up is because it could create a bit more volatility in the fixed income market globally, and that could be, I would see that as opportunity to add to fixed income risk. But yeah, I don't think this disagreement between the Fed and the market is resolved by any stretch just yet.
Well, we'll watch the headlines, and I'm sure all the investors will be looking keenly on fixed income in 2023. It leaves me to thank my panelists. Thank you very much for this time. Please allow me to thank the panelists as well. Thank you very much. Thank you, panelists, for the robust discussion on bonds. We've come to the end of the public broadcast and live stream of our Outlook event, and we'd like to thank members of the public and from the media for joining us. The next session is only for registered participants. For registered participants who are online, please click the link that you found in your registration email to join the private live stream. That live stream will begin shortly. See you there.